Next up, we have from Fintech to Finchain, the key role of stablecoins in LATAM. And we have on William Duran, the co-founder of Minteo. Let's give him a round of applause.
Thank you. Hello, hello. Hi guys, how you doing? How's Bangkok? How's the how's the jet lag? I got in yesterday at like 1 a.m., so I'm super fucking tired. My name is William. I'm co-founder and chief commercial officer at Minteo. We're a stablecoin issuer for Latin America. So you can kind of think of us as like a Circle or like a Tether for LATAM. Obviously, we're not printing the money that Tether's printing right now, but hopefully at some point we will. And I want to talk to you guys about the key role of stablecoins in LATAM. Okay, so I think that by 2030, stablecoins will be the dominant form of money in emerging markets. I think it's a pretty big statement, but we've seen the type of adoption the last couple of years with stablecoins. They're probably one of the few products that have really found huge PMF in crypto, and I think that's only going to continue increasing. But I think to really understand why stablecoins make a lot of sense going forward, I think we have to look at some of the use cases, and we have to see kind of those phases of stablecoin adoption, right? So I think the first phase that we had was stablecoins as a store of value. So when you look at, for example, USDT, USDC, DAI, they were a game changer for a lot of Latin American economies, right? If you look at inflation in Argentina, if you look at inflation in places like Venezuela, actually being able to hold US dollars, changed a lot of people's lives, right? So I think, in most of these countries, you can't even have US dollar denominated accounts. By actually being able to hold dollars, you can do much better for yourself, right? So I think, this is a quote from Kiao from Alliance DAO, basically saying that it's easier for people in developing countries to get access to USDC or USDT than it is to get actual dollars. And I really do think that helped a lot of adoption in Latin America. It was like the first big kind of game changer of stablecoin adoption. It still is. Then we had kind of like the second phase of stablecoin adoption, which is stablecoins as an investment product, right? So you look at, for example, US, Mountain Protocol, Rondo, or Ethena that actually allow you to invest in US Treasuries. Something that's previously was absolutely impossible. Here I have an example of like a Charles Schwab's brokerage account that requires you to put in at least a $25,000 deposit. I mean, $25,000 for someone in LATAM where minimum wage is $300, basically takes you like 80 years to open an investment account, right? It's if you save every single dollar for 80 years. So it's basically impossible. And I think that's a really novel use case of stablecoins, is actually allowing people in these emerging markets to invest in US Treasuries. So I guess the question is like, okay, there's a lot of hype, there's a lot of talk about stablecoins this year, and it's like, what's that next phase? What's that next phase of adoption? So we have it as a store of value, we have it as an investment product. The way I see it is that we're going to start using them as financial infrastructure. So stablecoins do not equal US dollars, right? I think so far we've seen that's been really the only, kind of like the only currency to have some sort of PMF or to find adoption. But I think what we're going to start seeing is that we're going to start seeing local economies operate with local currencies. For example, in Colombia, 97% of all transactions outside of like oil and gas happen in Colombian pesos, right? So I think in a way, what I see happening is that there's a bunch of like dollar liquidity, and a lot of that's going to start kind of moving into some of these specific countries, right? So you can think of it as kind of like last mile, like capital delivery into a lot of these economies. Where you're going to actually be able to start using these on-chain currencies for credit, for payments, for a lot of like the everyday stuff. And actually, one of the things that's important to understand is that we have really shitty financial rails in LATAM. So, we don't have, we basically have like, shitty banking infrastructure. So like, for example, one of our biggest banks was down for like 3 or 4 days this year. Like imagine not having access to a bank for 3 or 4 days. ACH is down all the time. Banks have like broken APIs or no APIs. So it's like, so if you're actually a builder and you're building products that have to connect with banks, it's extremely difficult and cumbersome. And then you have huge costs. So, Swift is expensive, ACH is annoying, and transfers of money even between banks can take a day, 2 days, sometimes 3 days, right? So actually that's one of the biggest factors, and that's one of the biggest limiting factors to build actually next generation financial products. And basically we don't have Venmo, we don't have Robinhood, we don't have Cash App, we don't have Bizum, we don't have SEPA, we don't have any decent financial products in Latin America. And it's basically because it's building financial products is super difficult. So I think one of the cool things that we're starting to see with blockchain, with crypto, with stable coins, and we have a term that we actually recently coined, it's called Finchain. And it's basically companies building financial services and consumer apps on top of public blockchains and stable coins. And we think really that's kind of the direction where we're heading. And just to give you guys kind of a better understanding, like the way we see it is like, you had fintechs which built kind of better consumer products, but on top of shitty legacy systems. And they did a really good job kind of building and like kind of connecting all these kind of broken systems together to offer a better experience. And then you have crypto companies that from day one actually build on crypto, right? So they offer better products, but they're still very nascent. And really where we think it all converges is in Finchain. So it's basically fintechs are going to use blockchains and stablecoins to enhance their products, and crypto companies are going to use them from day one because it's just better infrastructure. So I think in the future, all fintech companies are going to become Finchains, and all crypto companies are going to become Finchains. So these are a couple examples of like clients that work with us that actually use tokenized pesos. So Litio, they actually they're a neobank, and they have over 200,000 users that have cop and back debit cards. So you can actually save in USDC, but you can spend in Colombian pesos. You can invest in Colombian pesos, or you can, basically, it's like a multi-currency wallet. So you can use it basically anywhere in the world. We have ANSI, which does like credit default guarantees. And I think, credit is a very obvious one as to why you need local currencies on chain. You're not going to take out a loan in dollars and then, have to pay back in pesos, because then if the dollar strengthens, you're basically screwed. You can't pay back your loan, right? So there's a lot of things that are very obvious, like anything that has to do with credit. Obviously, you have to do it with local currencies. And then we have Unergy, which basically is a fractionalized solar energy platform and allows people to be able to invest with dollars into local energy projects. And they deploy a lot of that capital as well using on-chain local currencies. So, there's a ton of examples where this comes from, but actually anything that has to do as well with, like, for example, like real-world assets, I think it makes sense to tokenize in local currency. If you're going to tokenize a building, if you're going to tokenize credit. And this is really kind of the problem that we're solving. So I think, regardless of, what you think is going to happen next, I think, at least for me, it's very obvious that stablecoins are going to replace banking as a service infrastructure. They're going to be huge in payments. I mean, we saw with the Stripe acquiring Bridge. And what I really do think is going to be the future is going to be basically, at least in Latin America, all these new companies building on public blockchains and using stablecoins. So I think it's going to be a matter of time, right? Because there's a lot of regulation. There's a lot of, I think people have to get used to realizing that, like, at some point we're going to have everything on chain. But I think it goes by phases. So I think right now we're seeing, like, the need for, like, on-ramping and off-ramping. But the way I see the future is that we don't really have to do a bunch of on-ramping and off-ramping because you have local currencies on chain. So at the end of the day, everything just moves from dollars on chain to pesos on chain, and then from pesos on chain to dollars on chain, right? And I think that's ultimately how you close the loop. You need to be able to have local currencies on chain. Thank you, guys.